All right, and we are officially live. Let's do a little quality control check, my brother. Make sure that we are featured in Facebook group and in the um the YouTube page. Which one are
Let's
you
see.
checking?
I'm checking YouTube.
That
We
sounds
are in, yeah, we're in YouTube.
like okay.
So I'll share that.
Bro, you look like you got a haircut. What's up? You took a quarantine risk and got the haircut?
I had to go. I had to go do
Well,
something,
you had
man.
no idea. I'm rocking my hat with
I had to do something, man. You know, my barber's my boy, so I was like, hey, I'm gonna come through, get a quick cut, a lineup or something. It was getting wild up here, man.
telling me I'm about to do the Tarzan in a little bit.
Listen, man, my hair locked up. It's all locked. I mean, it's crazy.
All right, we'll get started here in another minute. Today we're going to talk about wraparound mortgages, the secret weapon
Yeah,
for a lot of markets for some creative financing, some deals. It's tough to do in all markets, uh,
definitely.
so we'll talk about it as far as what type of rules in different areas kind of lean for a more favorable outcome. Eh, all right, man, brother. I think we're ready to go. You ready?
I am good. Yep.
Where are we in everywhere?
Did you check the Facebook group? I didn't check that. I'll check it right now.
Okay. As of right now. So the idea of a wraparound mortgage while we get the party started is the property has existing financing already and you are negotiating terms with whoever your buyer is and offering them a new mortgage that will essentially wrap around the existing terms. So again, the main thing that I would definitely, the disclaimer is talk to your real estate attorney in your market and you may need to talk to a few because there is some ultra conservative real estate attorneys that will just say, stay away from it, can't be done. It's going to be a world of headaches. And the reality is, there are other attorneys that are well versed and experienced that will tell you exactly how to do it and what the pros and cons are for your market. Would you agree?
Definitely. Yep. We're live. We're live on all the groups. We can go. Cool.
All right. So right off the jump, why don't we talk about your specific examples? Let's just go right into it. Let's talk about your market. Let's talk about why in your market and wraparound mortgages are definitely a big tool for the creative financing deals and to make deals happen, essentially.
Yeah. Let me pull up this PowerPoint real quick. But like you said, I mean, a wraparound mortgage. Basically, seller A sells me a house. Let's say on seller financing terms. So he created a mortgage with me. I then go and find another buyer C, who I sell the house to him on seller finance terms that I created. So that's the route that I'm going with the ones that we do. We're not wrapping a sub two. Um, I don't I don't wrap sub twos. Honestly, I think that's the kind of a gray area because you're dealing with underlying. It could be federal. I mean, it could be conventional financing, whatever kind of financing it was. Um, I just don't like that model. But when you're buying a house from a seller that's free and clear, one thing we like to do is seller finance that.
All right, so let me break that down for people that might not understand exactly what you just said. So, what Jory was talking about was the simple fact that if it has a traditional mortgage that is on the property that he's buying initially, so if it has a Chase or a Wells Fargo or any bank, conventional FHA, whatever it might be, his personal preference and what the strategy is on the deals that are being done he does not wrap a mortgage around that. He will still pursue that as an investment deal and try to get that paid off. But he's not going to wrap a mortgage around it with his buyer when he turns around and essentially flips the property. But if the property is free and clear, meaning the seller who's selling to him does not have a mortgage on it, so he negotiated terms with that seller, and maybe that seller says, all right, pay me $50,000, $100,000 over the next 10 years at $700 a month, whatever the numbers that that you offer him and that you guys come to terms with. Then Jory turns around and markets that property as financing, private financing available. So people that traditionally may not qualify at the bank for an investment property deal or whatnot are going to be interested in that type of deal. So right off the bat, that's a hook to be able to get more people interested into the property you're selling, correct?
Correct, definitely, correct. I mean, this method is a method that we were talking about right now, especially in today's market, right? Is a method that everyone should be able to know how to use, right? Because the front end, we're using seller financing on the front end to acquire the home without any bank financing, right? And then we're offering the home to an end buyer who can't get bank financing probably, for a way for them to acquire the home. So, I mean, it's kind of like a cheat code if you ask me, if you know how to wrap it all up into one.
Now, a lot of people may be asking, well, why would someone want to accept your terms and not just go to the bank and get a loan? Or on top of that, why would you want to sell to somebody that may not get qualified at the bank?
Okay, so a couple of things. That person who accepts our terms could be two different people, right? A lot of our wraps, we wrap to investors, real estate investors, who could probably maybe get a bank loan, but the bank's gonna ask for 20% down, right? We usually only ask for 10% down. The bank's gonna ask for your social security card, your firstborn, your blood, a follicle of hair, right? You might already have your limit on conventional loans, correct? So you might be looking for either hard private money or, what we're offering, so that's one option right there. The other option could be a homeowner, right? Who simply can't get bank financing because they may have a couple blemishes on their credit report, right? That doesn't make them a bad borrower. They just don't qualify for bank financing.
Right. So are you taking a look at their scenario and situation and kind of underwriting it yourself?
We definitely do. We look at we do what I say is like a common sense, approval, right? We pull credit, we verify income, right? We want to make sure that the income can match the payment that needs to be made. We don't want to sell you a house, on a wrap where our payment's $1,000 a month, you're making $1,200 a month in income. That doesn't make sense. That's the common sense tells you that doesn't make sense, right? So, we do some common sense things and then we underwrite it that way. But the pool, right? The pool for who we're going after, who we're bringing in is a lot larger than the pool for conventional financing. So our pool's it's a lot more to choose from.
Right. A lot of people don't understand that sometimes, especially big time investors, a lot of the traditional financing is going to require, like you said, bigger down payments, but it's also going to require reserve requirements. So sometimes, depending on the loan program, they will need anywhere between 2 to 6 months of reserves. What reserves means is you need to have whatever the monthly payment is for each one of those properties multiplied by either 2 or 6. So if you have a big time investor that's stacking portfolio and he has 12 properties, 15 properties, plus, in order for him to have 6 months reserves for every single one of those properties, he may not, because he's making moves and buying other properties. He may have reserves, right? Because that's one of the things that we look at to make sure that he can cover payments. And if anything happens, he does have backup. But does he have 6 months reserves for every single one of the properties? Some very disciplined investors do, others do not. But with seller financing, none of those things apply. The seller, in this case, us, would use common sense and say, all right, well, listen, this guy doesn't have 6 months for all 15 of his properties, but he has $50,000 sitting in his bank account in case anything happens to any one of the properties at a given time, I feel comfortable doing a seller financing. And worst case scenario, if he doesn't pay, well, then you foreclose on him and take the property back.
Definitely. Another thing is a lot of new investors, right, who want to get into investing usually have none of the above you just mentioned, right? They usually don't have those reserves. They might not have the 20% down. You know, their credit still might not be perfect, but you know, this is a way to help new investors get their first property. I mean, there's a lady in Michigan who we've done this probably 5 or 6 times with. You know, she's an investor, and her main goal, you know, she doesn't care about much cash flow at the beginning. She's just trying to, you know, create some income where that she can make a couple, you know, probably 50 to 100 bucks per month. But she's bought like 2 to 3 homes a year on wraps from us, you know, and when she finishes it, she does the rehab. Because I go back, one thing that I do, these are all sold as is. We don't put in rehab into these homes, right? So I buy it as is, and I sell on the rep as is. She'll do the rehab, she'll get it running out, and when she's done with that one, after a few months, she'll call me again. You know, hey, Jory, I need another one. So this is like probably 3 times a year that we're selling her these homes on wraps, and she's never used a bank loan for any of her investment properties.
Yeah, 1,000. If you need to foreclose, God forbid, on any of these that you offered seller financing to your buyers, how does that affect your original agreement with the person you bought it from? So essentially, right, there's 2 mortgages on this property. The original one that you bought from the original seller, that's the one that you're responsible of paying to the original seller. And then the one that you made the agreement with your buyer, and now in this example, they stop paying you.
Got it. So 2 things. First, I always, whenever I buy a house instead of financing, I always buy it where I'm signing a mortgage and a note and getting the deed. Okay, when I buy it. Whenever I wrap it, I always wrap it on a land contract or contract for deed or agreement for sale, whatever it is in your state, right? Which does not transfer the deed to my end buyer. Okay, they get pretty much every right as a homeowner. They just don't get that deed until whatever the balance is paid off in full. Okay, so that right there does not, it takes away having 2 mortgages. We actually, you know, we file a memorandum of land contract or a memorandum of agreement to sell, which shows that we have this contract on place, but they don't have a mortgage, a note, and a deed. The foreclosure
it's structured exactly like the same thing. 2 mortgages, terms, everything's recorded. Right. It's just filed a different way, but still on public records and still legal in your market.
Yeah, yep. So if you check in, you know, let's say in Michigan, for example, if you check, I might have mortgage and note on my purchase, right? And then you'll see a memorandum of land contract on that same property showing an interest by that other homeowner who we wrapped it to, right? They have their interest there. So I can't go sell the house. You know, I can sell the note, which will get, that's a whole other, you know, topic, but they're the homeowner. I'm the bank, and then I also have another guy who sold it to me, who's the bank to me. Now, the process, we have to foreclose them, right? We went into default. I have to foreclose them.
Give me a second. It cut off a little bit. Let's go right back to where you were saying originally from about 1 minute ago.
Got it. So I still have a mortgage and a note with my seller who sold to me, and I'm creating another contract, seller financing contract with my buyer. Okay. So if they go into default, we foreclose, right? We sold them the house. There's not an eviction, so it is a foreclosure process. Now, in my states, right, that foreclosure process is shorter than if it was sold a traditional way, right? It might be a 6-month period for traditional financing. A land contract, it's 3 months period. Right? So there's the first benefit to doing it that way. Now, my agreement with my seller does not change. If the buyer I wrapped it to can't pay, I'm going to still pay my seller because I have an agreement with him. So that's the key. When you're doing these wraps, make sure you can make that payment to your seller in a situation where your end buyer can't pay. You still have an agreement to that seller. You can't call them up and say, hey, you know, I wrapped the house and they didn't pay me, so I can't pay you. It doesn't work that way.
Right. Now, also the flip side would be, God forbid, if any of you guys are trying to do this and you stop paying the original seller, that original seller still has rights to foreclose and will win in the court against your buyer because they're on land contract and they were basically last in the game, I guess you could call it. So that person then will probably file a lawsuit against you because they can prove that they were making you payments and you were being a shyster, not paying the original seller. So if you don't want to get in a world of problems, I highly suggest, no matter what, if your person pays you, no matter what financial situation you're in, make sure you pay the seller if you don't want to have the court system come down on you like a rat.
Yeah, I mean, I personally know investors during the last market crash who their model was buy it, wrap it, right? And then when it all crashed, they couldn't make their payments and they took off a lot of money. People were paying them, right? I've heard the stories, or I know these guys were doing this. And let's just say the power of the law it goes full force when you're messing with someone's, especially if you're wrapping to a homeowner, it comes full force. So by all means, make sure you guys are able to, fulfill your underlying requirements to your seller, when you're going to do this. Don't just start wrapping a bunch of stuff and you got, 10 homes and then they can't pay you. And now you can't pay your seller because, you end up in a lot of trouble.
Yeah. Now, if they don't pay you and then you don't pay, I would imagine you have to execute the foreclosure first and then your original seller executes the foreclosure right behind them and they would coordinate that. I think the only problem here that would be you would get into big time trouble is if they are paying you and you're choosing not to pay the original seller.
Correct. Yeah. If you're getting payments in, but then they find out you didn't take their payments and pay, your original seller, there's a lot of trouble in that. Definitely. Because now you've collected payments from someone you had some kind of mortgage agreement with, and you haven't made sure those payments fulfilled their balance. That's another reason why you don't want to do those reverse where, let's say I have a 5-year term on my mortgage and note with my seller, right? And then I sell it to somebody else and give them a 3-year term and it's paid off in 3 years, but I still owe 2 years. Like, you don't want to do that. You want to make sure that those terms equal, I will show you real simple, some diagrams of how I do it. My goal with this is to create cash flow. So, I'm getting in for 5 to 7 year terms with my seller, and then we're selling for 20, 25, 30 year terms to our end buyer, right? Because we're trying to create this generational wealth, this cash flow.
Now, before we get into the examples, can you break down the difference between land contract and transfer of deed? Because there's some people in the markets, like for example, Florida, where we don't deal with land contracts.
Got it. And again, land contract or contract for deed, whatever whatever it's called in your market, or agreement for sale. The number one difference, and again, I'm not a lawyer, so you have to always ask, but the number one difference I've always seen is that the deed is not transferred, right? So let's say Kevin has a house, and I say, Kevin, hey, screw the banks. How about you sell me this house for $100,000? I'll give you $10,000 down, right? What we'll do is I'll buy it from Kevin, and we'll actually sign a mortgage and a note, right, at closing. There'll be a mortgage, there'll be a note, and then Kevin will sign the deed, transferring the property to me, right? Now I'm the deed holder. I have deed in hand. When you sell it on land contract or contract for deed, right, whatever the form in that state is. So if it's Michigan, we use the land contract. The land contract form states all the same information you would find on your mortgage and note. It states the address. It states the terms of that loan, right? So it states $50,000, $5,000 down, 10% interest, 10-year term. The same thing you find in your mortgage, right, or your note. The only difference is at that closing is that memorandum states buyer will not receive a deed until this is paid off in full. Got it? And then it allows me as a land contract holder to have a little bit more flexibility in what I can do in terms of selling stuff off and also what I can put into that land contract. For instance, in our land contracts, we state that that homeowner cannot make any structural repairs to the house without our approval first, right? In the traditional mortgage, you can't do that, right? The more like the Bank of America can say, hey, you can't, knock out that wall and do this. They can't tell you that you can't do that. In our land contract, we have certain limitations in that land contract. So it's kind of a hybrid lease option mortgage. It's kind of how it is.
would you ever consider doing these type of creative financing if they're in a market that didn't have land contracts, you personally?
So if I could only do mortgage note, right, the traditional way, I would, yeah. I mean, I think I would, yeah, definitely. I'm not against that. I'm just saying if there's an opportunity to do it in a way that gives me more protection, I'm going to take the more protection.
Right.
More flexibility, I'd say. More flexibility.
Right. I think here the key more than anything is getting that that legal counsel on your team that makes sure whatever you're doing, it's airtight.
Definitely. And again, each state is different, right? I talked to, me and Kevin are private money mastermind. I talked to David Day on Monday, and he told me something that, we'll talk about later on, that he uses in his, when he does seller financing notes, which is different than what I do, which kind of blew my mind, So, we're just giving you options. The wrap as a whole is just when there's a mortgage, you bought the house on some type of mortgage, and then you sell to somebody else with some type of mortgage, right? There's A, B, or C. How you structure those is up to you and what you feel is best, right? But the strategy itself, which we'll get to here in a minute, has great benefits to it to help you create, generational wealth.
Yeah, 100%. Let's break down some of the deals that you've done. Let's share them, and we can end on that note so people can actually see examples of how this works.
Yeah, remember when I shared the screen, I won't be able to see you, Kevin, so.
That might be a benefit.
And present, make it big.
Yes, sir.
How's it look?
It looks good. We got a question. So buy on seller financing and sell on a land contract, right? If your market allows you to do that, then definitely that's the way to structure it.
Correct. Yep, correct.
All right. So tell me about this deal.
Got it. So this is a deal. So first thing I say, I'm gonna go back real quick, just to show you how we market for these deals. I think that's key. All right. All my marketing starts with marketing for wholesale deals, right? We're just doing our normal wholesale marketing. So direct mail, text, cold call, some PPC, driving for dollars, Facebook ads. All right. But number one list I use to find our financing deals is right here. It's what I call an empty nester owner occupant, right? These are investors who have owned that investment house for 30 plus years. Okay. And there's a few key reasons. First of all, these are investors who, if you bought your house in the 80s, if you were buying real estate in the 80s and the 90s, the late 70s, especially the 80s, you were probably using some seller financing terms to create a rental portfolio. Interest rates in the 80s were like 17, 18%. Correct, Kevin? I mean, yeah. There were times where they were very, very high. So bank financing wasn't what it was, nowadays. So people are being creative. They were doing different kind of notes and different kind of transactions, right? So they already understand the model of seller financing, right? Secondly, when this seller calls me and I ask him, why do you want to sell? His number one reason, his or her number one reason, most of the time is they're sick of being a landlord, right? They're sick of having tenants. They're sick of dealing with repairs. That tells me he still loves cash flow, right? So then all I do is jump in and say, hey, what if I can show you a way to still create cash flow without being a landlord, right? So I mean that list right there, combined with vacants and these is the number one list I use to try to hit these type of sellers up. So here's the deal. We got this house locked up for $28,000 on seller financing terms, right? We bought it traditional seller financing, mortgage and a note. $3,000 down, 0% interest, 54-month term, right? And a $500 P&I payment, which is principal and interest. Okay, one thing, P&I means principal and interest only. So I'm paying the seller principal and interest, and then I'm paying my taxes and insurance outside of their monthly payment.
Right.
Right. So these are our terms what we got it for. Okay, you see 0% interest. You can't find that at a bank. Not that I know of, right? So that's why I don't like banks. I like using seller financing terms.
Yeah, and for those of you wondering how we were able to get that deal at 0% interest rate, that's going to be part of the creative financing and how to pick up those deals. We will be doing a lot more trainings on those. So Um, for the purpose of this example, we're going to keep it moving. But trust me, there is ninja style negotiations that you can do to get these deals all day long.
All day long, yep. So what I did, we got this deal. We kind of evaluate different things, right? It was a single family home. We don't like to hold single family rentals at all. The home didn't need too much work, paint, carpet, a couple little updates, right? So what we do is we then market it, right, to a land contract buyer. And these are the terms we market it for, right? We market it for $45,000, $5,000 down, 10% interest, right, and 120 months. So that's the terms we're marketing to our end buyer that we're going to wrap this house to, with the P&I payment of $600 a month, right? So that's principal interest to us, okay? And we found a buyer for this pretty quickly. I mean, we had a couple people who wanted it. We found a buyer for this pretty quickly, right? So with us buying it for these terms and selling it for these terms, we made $2,000 at close, okay? So not only did we not come out of our pocket for any money besides the marketing that we spent on this campaign, we made $2,000 at close, right? We cash flow $100 a month, and then after the first 4.5 months, we'll have this property free and clear. So then we'll have $600 a month payment for pretty much 5.5 years free and clear, unless they pay us off early, which no one's mad about that.
Right. So let's recap this deal real quick. You picked up this deal at $28,000. You promised the seller you were going to give him $3,000 down payment, and for the next 54 months, you were going to pay him $500.
Correct.
That was the negotiation you made with the original seller.
Between me and the seller, correct.
Right. Then you started marketing this property to the buyer's list, Facebook Marketplace, Craigslist, everywhere.
Email blast.
Saying, buy this property for $45,000 with only $5,000 down payment. You got hit up like crazy, and then you found the right buyer who agreed to pay you at 10% interest for 120 months. So that, at the end of the day, is 10 years, correct?
Correct. Yep.
So you are going to collect a payment of $600 a month. So you are giving the seller $3,000 up front, and then the buyer that you sold it to is giving you $5,000. So quickly you take that $5,000, give the seller his $3,000, and you keep $2,000 right from the beginning.
Exactly, because remember, the buyer is paying all the closing costs, right? So the buyer probably brought in, close to $6,000 in closing costs. The seller gets his $3,000. I give him, in this place, the seller got her $3,000. I got the $2,000 right there at the beginning, at close.
Now, on top of that, the buyer you found is going to pay you $600. You got to pay the seller $500. So you're going to make $100 profit per month for 4.5 years until you completely pay off the original seller who sold you the property. Then for the next 5.5 years, after you pay this property off, your cash flow increases to the full $600 until they completely pay you off.
Exactly. Correct. Yep.
And if you do 20, 30, 40 of these in a month, all that starts to obviously add up.
Exactly. Yeah. And if you do one a month, then it's, like let's say you can only do one, you're doing 12 a year. It's, it still adds up, right? Because it's compounding. When that starts paying off, our goal is to take all that extra cash flow and pay down the lowest balance we have too. So no matter what happens, you pay down this balance early, and then you're taking that to the next house. Right.
So
another thing.
If you pay it off faster, you'd be making that $600 a month a lot faster.
A lot faster, yep. And that gives you more cash flow to pay down the next one a lot faster. And the key to this is we sold it as is, right? When that seller sold in terms, they were happy they were no landlord, right? But they're still getting cash flow. They actually get that $500 a month to them is more than what they made as a landlord. We talk about that a lot because when you sell on seller financing, you're now the bank. You don't fix anything. You don't pay taxes. You don't pay insurance. None of that, right? So that $500 to that seller is locked in. This poor lady looking to retire. She was sick of being a landlord. Now she has this income of $500 a month on a $28,000 house, right? And then We went around and did, and we have fixed income. We know what our numbers pay consist, like they're supposed to.
Right. We had that question of how are you able to find these buyers? We kind of touched on it right now, where you got your buyers list, you have all your realtors in your local market as well on your list. You're posting it on Facebook Marketplace, you're posting it on Craigslist, you're posting it on every free posting or even paid posting sites for properties for sale.
You're putting a sign in the yard for every house that you might own, right? Not just this house, but just putting a sign in the yard, right? Another two, don't put a down payment on an advertisement, right? Let them call in, ask them what they have to put down, because you never know, right? But the main thing is you're saying a price, right? No bank financing, easy approval process. Those key words that the pool of people who can't, get a house traditional financing is going to trigger them. And then second most part about this model, that per month plus their taxes and insurance, less what they pay for rent for that same house. That's the key.
Say that again. Say that again.
The homeowner who we sold the house to, their payment to me plus their taxes and their insurance is less they would pay if they were to rent that house out. It's less. I mean, that right there is the whole key, right? If you can structure these where they can come in and either pay even, because let's say it's the same amount of payment, but people get to own a house, they're gonna be happy with that. But we usually make it where it's a little bit less, $50 less, not a ton, but $50 less than what you pay for rent, and you're owning the house is a big deal to someone who owns a house, right?
Right. We got a question. Do you escrow taxes and insurances to the end buyer, and what are the pros and cons? So for your buyer that came and bought it to you for $45,000 and $5,000 down and has to pay you $600, are you collecting taxes and insurances as well?
Got it. So we do a mixture of both, right? Some we don't, some we do. I'll say this right now, moving forward, right, with a lot of the uncertainty in the market right now, moving forward, we are on every one, because we don't want to have a buyer who's, let's say something's happened and buyers a little more shaky. You don't want to get 2 years down the road and get a tax bill that hasn't been paid, and then you have to come up with that cash, right? So we probably did that less in the past, but moving forward, we're going to probably do it on every one. We're just underwriting everything a little bit more tighter, just like the traditional banks are.
The pros and cons is if they're making payments to you, they're paying that $600 a month in that example, but they don't pay insurances, and God forbid there's a fire, which we know happens because we buy firehouses.
Yes, we do.
So at the end of the day, we don't want our house that we just sold to be one of those firehouses. And what happens is those firehouses, 9 out of 10 times, don't have insurance on them. Mm-hmm. So you get stuck where you're trusting your buyer is staying active on the insurance payments and doesn't lapse. And here's the reality. A lot of these buyers, it's not that they purposely didn't want to pay insurances, but they forget, or they didn't get the bill in the mail, or they're just disorganized, and there might be a temporary lapse where they go 6 weeks without any insurance because they missed the bill. They forgot. They didn't put it in the mail. It didn't happen. Okay. What if in those 6 weeks, hurricane comes, earthquake, tornado, fire? Your property's gone and there was no insurance on it. The times that we have taken deals that have gone what we call no escrow, meaning they're responsible for the taxes and insurances, they've been an A+ borrower, meaning great credit, reserves, and they've put a large down payment. And even then, me personally, I'm uncomfortable with it. I understand that there's a lot of work behind collecting taxes and insurances, and then you got to be on top of it when the bill comes and pay it. But there is servicing providers that you can sign up with, and they handle all that for you.
And servicing companies are like $18 to $25. Like, they're very, very inexpensive. Most of them, depending on what you have to use for them. So, another thing with insurance is we require before close, even if we didn't escrow it, that we have proof of insurance that has our company as additional insured on the policy. Make sure, just like when you loan money, cause I've gotten loans from you for houses. I can't close on the house until that insurance rider sent to Kevin showing that his company is added to that policy as insured. Right. So you have to make sure you do that.
So what happens is that's why I don't really like no escrow, me personally, because either way, when I get the copy of the bill, because I'm also added to the policy, I have to double check and make sure it's still paid. So, and if it's not paid, I have to then call the person. Hey, I just got a letter from the insurance company saying you haven't paid. What's going on? We're gonna make a payment and put forced place insurance on this property, and you get into that whole mix up. And I rather not. I rather out of $100 cash flow, pay the $15-20 service fee, have a service provider worry about all those things, make those payments, distribute the money to whoever needs to get paid, because you got to be on top of it regardless. You got to check taxes. Where taxes paid by April every year. Reminder, you have someone on your team, check, or you yourself, if all the properties you have under seller financing, or if you've done a private lending and you own the note, have they paid the taxes? Even if you own the note and you're the bank, you want to double check that, because if someone else buys that tax certificate, then you got to start negotiating with them.
I'm making phone calls right now for a couple of them, just verifying that, right? Because there's so many we didn't do escrow, so I have to verify that taxes were paid, so definitely.
Yeah. So we got time for one more right before I gotta get off. I got a 2 o'clock.
Yeah. Good. Here we go. We'll share another example.
All right.
Here's another one. Another one that we bought. Right. We bought in seller financing terms. We wrapped it on land contract. Okay. Again,
you got this one. You marketed to the non-owner, so this was an investor, and you got it through a direct mail postcard.
Exactly. Yep. Got this one. Vacant house. Seller had, house been vacant for probably 2-3 years. We negotiated him down to $17,000 for the house. Right down. We did this. We paid him $2,500 at close, and paid him $2,500 3 months later. We were in the middle of rehabbing a couple houses right now, and just wanted to make sure we had, cash flow reserves available. So I was able to negotiate for him to take that payment in 2 payments. Interest rate of 4%, 2-year term, 24-month term. All right, P&I, principal and interest payments to my seller of $521.10. Those were my seller financing terms.
So you told the guy you were going to pay him back the difference of $12,000, because after 3 months you gave him a full $5,000, and you were going to pay him back in 2 years, by making $521 payments every single month for 2 years to pay back the $12,000 balance.
Exactly. Yep. That's what we told him. And then, so again, we got it locked up. We went to market it, right? So we marketed it, $40,000 price, $5,000 down, 10% interest, 11-year term, and a payment of $531.10 per month. That's how we market it, right? So you can see, first of all, we got it accepted pretty quickly. You see, our cash flow is not even that much. We're making $10 per month, right? But our term, this is paid off in 2 years. So after 2 years, $531.10 per month, right? So we've done that. We bought a house last year, so the terms that we were actually making negative per month, but we paid the house off in a year. So I'm looking to get some huge cash flow from the door. It's, how long till I get that, that cash flow that we want. And in this case, right, in years, we're going to be bringing in $531.10 per month, free and clear.
And then here you said buyer ended up having to move in March of this year?
Yeah, so buyer ended up having to move in March 2020, right? So the buyer moved. So what do we do, right? So let's say it was a default. In this case, it wasn't a default. We actually worked some stuff out where the buyer actually moved into another property that we have and quick claim deeded this one back to us, right? But remember, so on this deal right here, The buyer gave us $5,000 down. So we came out of our pocket zero, right? Our down payment was $5,000, right? So we broke even, but remember we only put $2,500 down at the time, so we actually had $2,500 to use for operating until our next 3 months, right? But so what happens when the buyer leaves? We remarketed and got another buyer without any vacancy. There was no break in vacancy or payments, right? Got another buyer. The terms changed a little bit on the term as far as the length of the loan, but the price was the same, the down payment was the same, and the interest was the same on a back end buyer.
You just replace them.
You just replace them. Yep. Just replace the buyer.
Yeah.
Right. So we actually got 2 down payments of $10,000 on that property, that one property.
Now you're making money.
Yes. And this house will be paid off in August of next year if we don't pay it off sooner. I mean, my goal, I talked about our goal is to pay this house off this year, right? Because what we owe on this house right now is not that much. We take one wholesale deal and pay this house off.
Right. And then you keep the $530 a month cash flow for the next 10 years.
Exactly. Yep.
Beautiful. That's creative financing at its you got I hear an echo. You got something on?
I hear an echo on your side. I don't know. Is it coming from me?
Do you have YouTube or Facebook open by any chance?
No, I don't. I don't have anything open up.
The audio is starting to go bad now. That's weird.
You still hear it?
Yeah, it wasn't happening before. No, that's it. It stopped.
Okay. I stopped the share. Maybe it's when I was in between stopping the share.
Okay. All right, perfect. So that's creative financing at its finest. That is the type of deals that in a lot of markets can be done. That is what a lot of the people that we work closely with is partnering with us on. Again, we would definitely be interested in doing this in other markets. If you have a market that you think this would be clutch in, reach out to us. If you have more questions, join our Facebook group. We have a Facebook page. We have a Facebook group. Join the Facebook group. Join the community. Shut up and invest. We're across the board, all social medias. Anything you want to add, Jay, before we go?
No, again, look, me and Kevin are open to partner, to help guys out. If you have a deal like this that you don't know how to structure it, right? You have questions, reach out to one of us. We can kind of walk you through it. These deals are there. I mean, people say, how do you get deals at 0% interest? They're there. We get a lot of them. So reach out to us on that. And the Facebook group too. We're gonna be doing some exciting things in that group. Me and Kevin right now are working on some courses we're putting together that'll only be available in that group. We actually sent out that we're in a private money group right now. Raising private money, mixed with creative financing are the tools you need to be able to succeed in any market, right? So right now, let the market do what it wants, right? I'm going to adjust the way I need to adjust. Well, we have tools that we can use in any kind of market, right? So between the private money mastermind we're a part of, if you want to find out how to raise private money, holler at us about that. Between the creative financing stuff we're going to be bringing out, we're just trying to equip everybody with these tools that we know will help you become a true investor.
There you go. I think we killed it on that one. And with that, we might be even able to throw this on the podcast. We got to listen to it again and see. We might throw it out on all the podcast channels. But check out our YouTube. Make sure you subscribe to our channel. Like it. Comment on there. The more love we get on YouTube, the more of these videos we're going to be making. Appreciate you guys. You got anything before we go, brother? Are we done?
We're done, man. I'll talk to you later on tonight, man. Shut up and invest.
Shut up and invest.